Remgro is next. This one, of course, came out of the Rupert family deconsolidation, and what you're talking about here is the South African listed holding entity for all of the assets we'll talk about in a minute. Market capitalization of this one, 114.3 billion rand. So big by our standards. Price to earnings ratio 16.6, dividend yield currently 2.17%. So just take us through the underlying bits and pieces like you did earlier.
The big chunk of Remgro when you're buying a Remgro stock is you're getting a whole bunch of Mediclinic shares. Then on top of that, you're getting a whole bunch of banking and insurance shares, specifically Rand Merchant Bank and MMI and FirstRand and all that. That together makes probably 50 to 60% of the actual underlying business.
Yes.
Then you've got the other listed entities, a little bit of Distill, a little bit of Rainbow Foods, and then you've got the interesting unlisted stuff like Unilever being a good example. That would be the biggest unlisted holding. And you've got little chunks of CIV, which would be the Dark Fiber Africa that they want to spin off at the moment. A little bit of ETV, a little bit of Seacom Cables, but that's all bits and pieces.
A little bit of Total South Africa.
Yes, that's correct.
That puts you in oil. You know, some other food assets like Robertson's and other things.
But those are tiny. You know, when we're looking at it, you're basically buying Mediclinic and FirstRand and a bit of insurance essentially.
But let me just say, in the prior decades, there were all sorts of other things that they had in there, like, you know, piece of Goldfields or some Impala.
They had everything. Yeah, they unbundled that Impala part as well.
Those are good that they're gone.
Transex Diamonds they took out.
The stuff that they were in that they're not anymore, that you may argue would be things like Vodacom at some point, or the predecessors of Vodacom and Venfin and some of those other things. But look, you get the quality, firm hand of the management team, which is Johan Rupert, and then, you know, his various executives. So that's not to be sneezed at. Very low operating costs in terms of their management function. So it's a great way to get, you know, almost instantaneous access to that financial services, consumer and healthcare type coverage, which we like, it must be said.
Correct. So it's I would call it a cheaper entry point, but it's a great way to diversify your portfolio. If you don't want to buy Mediclinic directly or MMI or FirstRand directly, you can get into Remgro. And if you'd like to have that diversification with having an exposure to a bit of food, bit of healthcare, bit of insurance, bit of banking, it's good to go for.
Here's the point. FirstRand currently getting vogued in a downward direction.
And Mediclinic as well.
Mediclinic up today, but in general getting sort of thrashed a bit.
You can see on the share price right there. I mean, down from, where was it, about 250
well, let's look at
the
the share price. There you go.
So there we go, from about almost 270, excuse me, and it's just had a little bit of a torrid time. But if you look precedingly from about 2012 upwards to 2015, you've seen spectacular returns.
Indeed.
So for the patient investor, you're still doing well. For the impatient, which we all are, unfortunately, you must be a little bit irritated with your position at the moment. But mainly due to the fact that Mediclinic and FirstRand have seen substantial declines recently.
Bit of a retracement in recent times, particularly Mediclinic, because Mediclinic was responsible for a lot of that move higher. Just on Mediclinic, we do own those. It's doing great in Switzerland, and it had a recent regulatory thing which happened.
Thankfully, that was a lovely thing to look at.
It's doing better than its competitors here in South Africa in a somewhat difficult and maturing market. It's having some tough times in, you know, the Middle East, but those, I don't know, I guess there's...
That's actually the big issue at the moment, I think, for us as investors, is having a look at, you know, the amalgamation of Al Noor and Mediclinic together into, a, you know, a synergetic kind of business.
Abu Dhabi government used to say, if you're a citizen, it's on the house. You can have as many procedures as you like, top of the range. Then they said, no, no, no. We're having austerity now. You have to pay 20%.
Correct. So it's a bit of a turnaround. I mean,
sounds like a good deal still.
Government was very open originally, you know, wanting to get as much foreign investment as possible and change their tune. And that is the risk with any business, is government regulation can have an effect on your business. And as an investor, you need to take that into account.
Anyway, I'm getting a bit distracted here because the finance thing is always... What about Remgro, right? If you...
All right, so these companies, what's very important to discuss is that we need to look at net asset value. A lot of the holdings are listed entities. You can work out what the values are. You can price that back into real terms, divided by the quantity of shares in issue, and you get something called an NAV, net asset value. You know, so Remgro trades at a discount. It always has. You know, that's the rule of thumb when you look at investment holding companies that tend to trade at a discount. What's important is what is the average discount. If it's above that average discount, the stock's looking cheap. If it's below that average discount, the stock's looking a little bit expensive. And at the moment, Remgro's trading at about a 16, 17% discount to NAV. It usually trades between, I would say, 12 to 13. So at the moment, it's a little bit stretched to the downside, and it's looking a little bit more attractive to actually purchase stock. So I would be a buyer of Remgro at the correct level, of course, and that would be between 200 and 210 in my opinion. And I think you've got a decent buffer of a discount to NAV to make it worth your while.
Okay, so I'm going to follow with you and go hot on that one.
Yeah,
I think
hot on
currently
that,
the Mediclinic opportunity should be
seems to be turning
enough
from a low
to
base and
get them going, even though I'm a bit worried about the financials.
Yes.
We used to own some first strain in the portfolio. We're not in those anymore. Okay, let's keep going. The next